Hey everybody, I just vomited everywhere because I looked at my portfolio. What I want to share with you guys is something that I look to help me and keep me from panic selling, because panic selling is one of the biggest mistakes we can make as long-term investors. It's how we interrupt the compounding process, and it's something that anyone who's gone through a financial crisis or any sort of turmoil, if you talk to them about what do they wish they didn't do, it's always they wish they didn't sell. That's what I found. So I want to share with you several quotes here that come from legendary investors, classic investing books that have helped me and help me right now from panic selling and making sure I stay the course, like Jack Bogle says. So let's check it out. The first one comes from Charlie Munger, who says, a lot of people with high IQs are terrible investors because they've got terrible temperaments. And that is why we say that having a certain kind of temperament is more important than brains. You need to keep raw, irrational emotion under control. You need patience and discipline, and an ability to take losses in adversity without going crazy. This next quote comes from Benjamin Graham. The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. This next quote comes from Benjamin Graham's most famous pupil, and that is Warren Buffett. When the price of a stock can be influenced by a herd on Wall Street, with prices set at the margin by the most emotional person, or the greediest person, or the most depressed person, it is hard to argue that the market always prices rationally. In fact, market prices are frequently nonsensical. This next quote comes from one of my favorite investing books. It's called The Warren Buffett Portfolio by Robert Hagstrom. Even those who understand intellectually that such dips are part of the normal course of events may react emotionally and fall into panic. One of my other favorite investing books is called A Random Walk Down Wall Street, and the author, Burton Gordon Malkiel, I'm probably butchering his name, I apologize, says the following. And just as herding induces investors to take greater and greater risks during periods of euphoria, so the same behavior often leads many investors simultaneously to throw in the towel when pessimism is rampant. The media tends to encourage such self-destructive behavior by hyping the severity of market declines and blowing the events out of proportion to gain viewers and listeners. Even without excessive media attention, large market movements encourage buy and sell decisions that are based on emotion rather than on logic. This next quote comes from Howard Marks. The power of psychological influences must never be underestimated. Greed, fear, suspension of disbelief, conformism, envy, ego, and capitulation are all part of human nature, and their ability to compel action is profound, especially when they're at extremes and shared by the herd. They'll influence others, and the thoughtful investor will feel them as well. None of us should expect to be immune and insulated from them. Although we will feel them, we must not succumb. Rather, we must recognize them for what they are and stand against them. And this is the key point. Reason must overcome emotion. Our natural instincts is to lock in our gains. It goes back to a lot of psychological biases like the disposition effect, like prospect theory. I could go on, but you get the idea. I hope your portfolio is not taking too much damage. This too shall pass. This has been Chris Franco for CMQ Investing. Thanks for watching. Make sure you hit the thumbs up, hit the subscribe button, share it with a friend, and more importantly, I hope you're able to use it and benefit from it. Our natural...
Hey, buddy. You can't make me laugh.
Hey, buddy.